Right now, Globus Medical, ticker GMED, is trading live at $83.46. That's a very minor move, down about 0.52% in live intraday trading on this November 10th, 2025. But let's be absolutely perfectly clear. That 0.52% dip is not the story. It is a rounding error. It is a brief pause for breath, a moment of consolidation after what has been one of the most violent and vindicating repricings we have seen in the medical device sector all year. The real story is that this $83.46 price tag comes after the stock exploded by more than 35% in the last 3 trading sessions. This is not a stock that is down today. This is a stock that has just launched into a new orbit, and today's calm is simply the market trying to figure out what just happened. The expectation, the narrative that has defined this company for the entire last year was that Globus Medical was a show-me story, weighed down by a risky, complex, and potentially value-destroying $3.1 billion merger with NuVasive. The reality, delivered just last week, is that the merger is not a failure. It is a stunning, undeniable, and wildly profitable success, and it has caught an entire market of short sellers and skeptics completely off guard. This is one of the most powerful examples of the market's expectation versus reality. Let's establish the common ground, the story everyone thought was true up until last week. The general belief, the one that had this stock languishing and down more than 25% for the year, was that the NuVasive merger was a terrible mistake. You had 2 spine industry giants, Globus and NuVasive, combining in an all-stock deal. The street consensus was that this was a recipe for disaster. The expectation was for massive dis-synergies, a term for when a merger actually destroys value. The theory was that these 2 companies, with their 2 different cultures and, most importantly, their 2 highly paid, highly competitive, commission-based sales forces, would tear each other apart. The expectation was that the best sales reps from both sides would get nervous, see the writing on the wall, and flee to competitors like Medtronic, Stryker, or Johnson & Johnson, taking their deep surgeon relationships with them. This was the bear case, and for a full year, it was winning. And then, on November 6th, reality hit. Globus Medical reported its third quarter 2025 earnings, the first clean look at the combined entity's power. And it was not just a beat, it was a complete and total annihilation of the bear thesis. The market was expecting chaos. Globus delivered a masterpiece. The headline numbers are staggering. The analyst consensus expectation was for adjusted earnings per share of 79 cents. Globus delivered $1.18. That is not a beat, it's a 49% surprise, a statistical impossibility if the bear case had been true. On revenue, Wall Street was hoping for $734.5 million. Globus delivered $769 million, blowing past the high end of all estimates. And then the knockout punch. Management didn't just meet guidance, they raised their full-year forecast. This is the entire story why the stock is at $83.46. The market was pricing in a messy, high-risk integration. The company delivered a 22.9% year-over-year revenue growth rate, a 26.2% year-over-year increase in adjusted earnings, and record free cash flow. This is a public vindication for management. It proves unequivocally that the integration is working. The cost synergies are real. The sales force has been stabilized. And the combined entity is not the 1 + 1 = 1.5 that bears feared, but a 1 + 1 = 3 powerhouse that is now the undisputed #1 player in the spine market. For anyone doing self-investing who held this stock through that year of pain, this was the moment. This is what you see on a Fidelity mobile app or a Robinhood app that makes you question your sanity, and then, in one 72-hour period, makes you feel like a genius. But here is the new conflict. Here is the part that everyone who just piled in on that 35% spike might be missing. This is the new expectation versus reality that is forming inside these blockbuster numbers. If you just read the headlines, you'd think this was a flawless report. It was not. Digging into the SEC filings, into the 10Q, reveals a fascinating and deeply concerning new problem. The company is now a tale of two cities. We all assumed the growth engine, the crown jewel, was Globus's high-tech enabling technologies division, specifically the Excelsius robotics platform. This was the NVIDIA stock of the spine world, the thing that was supposed to create a sticky, high-margin ecosystem. The boring part was the musculoskeletal solutions, the screws, rods, and implants, which the NuVasive merger just doubled down on. The reality in the Q3 report is the exact opposite of that narrative. The musculoskeletal division was the hero. It posted $741 million in sales, shattering the Wall Street consensus estimate of $793.9 million. This is the old NuVasive business, now integrated, firing on all cylinders. It is a monster. But the Enabling Technologies division, the crown jewel, the robot, it was a catastrophic miss. Sales for that division came in at just $28 million. The analyst consensus was for $40.2 million. That is not a small miss. That is a 26.8% decline from the same period last year. This is the new paradox of Globus Medical. The stock just had one of its best weeks in history because its legacy lower-margin implant business, now merged with NuVasive's business, is a cash flow gushing behemoth. But its future, its high-tech, high-margin robotic story just fell off a cliff. This is the new conflict that self-investing individuals and professional traders on interactive brokers are now trying to decipher. Why did the robot sales collapse? Did the integration of the two sales forces cause the old Globus reps to lose focus on selling capital equipment, which has a long sales cycle? Did the new NuVasive reps just not know how to sell this complex robotic system? Or is something darker at play? Are hospitals in a tight budget environment simply saying no to new robot purchases? And is the golden era of capital equipment in MedTech over? This is why today's 0.52% dip is so interesting. The dumb money is just celebrating the 35% gain. The smart money, the institutional investors in Fidelity mutual funds and those with Fidelity Wealth Management advisors, are now trying to model the future. The company's valuation has just been completely reset. It's no longer a high-risk merger story. It is now a dominant, number one in spine, cash cow story. The market has proven it is willing to pay a premium for that, and the $83.46 price reflects that. The old bear case is dead, but the new bear case is that the company's long-term growth engine, the robot, has just stalled. If this 26.8% decline in tech sales is not a one-quarter anomaly, but is a start of a new negative trend, then all the financial models that projected Apple stock-like ecosystem margins are wrong. This is a critical moment for the company. They have successfully executed one of the most difficult, large-scale mergers in modern medical device history, and they did it with surgical precision, as proven by the Q3 numbers. The expectation of failure was met with the reality of a massive earnings beat. This has given management an incredible amount of credibility. Now they must use that credibility to answer this new, difficult question. I want to know what you think. Comment below with your take. Is the 26.8% collapse in robot sales just a one-time integration hiccup? Or is this a sign that the enabling tech boom in spine surgery is officially over? This makes the future outlook a fascinating two-sided coin. The bull case, the new expectation, is that the $83.46 price is just the beginning. This case says the musculoskeletal division is the new, stable, profitable core. This 741 million quarter proves they are the dominant force and can print cash. The bull case says the robot's bad quarter was just an anomaly, a simple side effect of a massive Salesforce integration, and that as the new, larger sales team gets trained, they will now be able to cross-sell that robot to the massive legacy NuVasive customer base, which will reignite that tech growth in 2026. If that happens, this stock is going to $100 easily. The bear case, the new reality, is that the stock's 35% run-up was the entire repricing. The market was right to punish the stock, and it is now right to reward it. But the $83.46 price now fairly reflects the company, a highly profitable but slower-growing, boring